Nichedge Academy. Hindsight bias. Disclaimer. The information provided by Nichedge Academy is protected by copyright and is intended for educational and informational purposes only. It may not be reproduced, distributed, or used in any manner without the express written permission of Nichedge Academy. Please at your own time read through the disclaimer at your own discretion. Retrospective analysis is analysis often used to highlight potential investment opportunities or showcase the performance of certain assets over a specific time period. This concept involves looking back at historical data and calculating the hypothetical gains or losses that could have been made if an investment had been made in the past. It is important to note that this analysis is based on historical data and does not guarantee future results. While this concept can be used to illustrate the potential profitability of certain investments, it should not be solely relied upon for making investment decisions. It is always best practice to conduct thorough research, consider various factors, and consult with financial professionals before making any investment choices. The concept. It is essential to understand that it is not necessarily a trick in itself, but rather a way to analyze historical data performance and understand hypothetical scenarios. First, historical data. Hindsight bias relies on having access to historical data such as stock prices or other asset values with a specific time frame, say the past 10 or 15 years. Second, analysis. Analysts or investors use this historical data to determine what would have happened if they had purchased a particular asset or securities at a specific past date. They calculate the potential return on investment based on the historical performance of those assets. Third, investment decisions. The analysis provides insights into the potential gains or losses that could have been made had an investment been made in the past. It helps investors understand multiple assets and timeframes. Understanding and being able to trade or invest across multiple assets and timeframes before specializing in just one can be crucial for several reasons. First, diversification. Trading or investing across multiple assets allows for diversification, which helps spread risk. Different assets may perform differently under various market conditions, so having exposure to a variety of assets can help mitigate potential losses and increase the chances of overall portfolio growth. Second, risk management. By trading or investing across multiple timeframes, you can manage risks more effectively. Short-term trading may involve higher volatility and risk, while long-term investing may offer more stability. Having a mix of both can help balance risk and potentially enhance returns. Third, market understanding. Engaging with multiple assets and timeframes provides a broader understanding of different markets, sectors, and economic factors. This knowledge can help identify correlations, trends, and opportunities that may not be apparent when focusing on just one asset or timeframe. Fourth, adaptability. Markets are dynamic and can change rapidly. Being able to trade or invest across multiple assets and timeframes allows for greater adaptability to changing market conditions. It enables you to adjust strategies, take advantage of emerging opportunities, and navigate through different market cycles. Fifth, skill development. Trading or investing across multiple assets and timeframes helps develop a wider range of skills and strategies. It allows you to gain experience in different trading styles, technical analysis techniques, and fundamental analysis approaches. This broader skill set can be valuable when specializing in a specific asset or time frame later on. While specializing in particular asset or time frame can have its advantages, having a foundation in trading or investing across multiple assets and time frames provides a more comprehensive understanding of the market and enhances your overall trading or investment capabilities. Professional versus retail. The difference between professional and retail trading approaches lies in the level of expertise, resources, and regulations involved. First, expertise. Professional traders typically have extensive knowledge, experience in trading in financial markets. They often work for financial institutions or hedge funds and may specialize in specific assets or trading strategies. Retail traders, on the other hand, are individual investors who trade with their own personal funds and may have varying levels of market knowledge. Second, resources. Professional traders often have access to advanced trading tools, research, and market data provided by the institutions. They may also have larger capital bases and the ability to execute trades with lower cost and faster speeds. Retail traders typically have limited resources and rely on retail trading platforms and tools available to individual investors. Third, regulations. Professional trading is subject to stricter regulations and oversight as it involves managing other people's money. Professionals may need to adhere to specific licensing requirements and comply with industry regulations. Retail traders, while still subject to certain regulations, have more flexibility and fewer regulation obligations. Fourth, risk and return. Professional traders often take on higher levels of risk due to their sophisticated strategies and larger positions. They may aim for higher return but also face potential losses. Retail traders generally have a more conservative approach and may focus on preserving capital and generating consistent smaller returns. First, we got the outcome. The outcome of professional trading is typically measured by the performance of the funds or portfolios managed. Professionals may receive performance-based compensation. For retail traders, the outcome is based on the individual trading results, which can vary widely depending on skills, strategies, and market conditions. It's important to note that these are general differences, and there can be variations with each category. Both professional and retail trading approaches have their own advantages and risks. An individual should carefully consider their goals, risk tolerance, and available resources before choosing an approach. Consulting with a financial advisor or professional can provide further guidance tailored to specific circumstances. Top-down versus bottom-up. Top-down analysis and bottom-up analysis are two different approaches used in investment analysis. Top-down analysis involves starting with macroeconomic perspective and then narrowing down to specific investments. It begins by examining the overall economic conditions, GDP growth, interest rates, inflation, and industry trends. Based on this analysis, investors identify sectors or industries that are expected to perform well. They then select individual investments within those sectors. On the other hand, bottom-up analysis focuses on analyzing individual companies or assets without considering broader economic factors. It involves evaluating the company's financial statements, managing team, competitive position, and growth prospects. Investors using this approach believe that the intrinsic value of a company or asset is more important than macroeconomic factors. Technical analysis, on the other hand, is a method of evaluating investments based on historical price and volume data. It involves studying charts, patterns, and indicators to predict future price movements. Technical analysis is primarily used for short-term trading and relies on the assumption that historical price patterns will repeat in the future. While technical analysis can be useful for certain assets, it may not be applicable to all investments. Some assets such as stocks of young companies or assets in emerging industries may not have sufficient historical data for technical analysis to be effective. Additionally, fundamental factors like company financials and industry trends may have a stronger impact on the performance of certain assets, making bottom-up or top-down analysis more relevant. 3. The choice between top-down and bottom-up analysis depends on the investor's preference and the specific investment being considered. Technical analysis can be a valuable tool for certain assets, but it may not be universally applicable to all investments. The concept. While the concept of looking back at past investment performance can be used for both short-term and long-term analysis, it is true that it is often more commonly associated with short-term perspectives in the context of Wall Street. Short-term analysis focuses on shorter time frames, typically ranging from days to a few years. It involves evaluating market trends, price movements, and other factors that can impact investments in the near future. By examining historical data and calculating potential gains or losses, investors can assess the profitability of short-term investment strategies. Wall Street, as a hub of financial markets and investment activities, often emphasizes short-term trading and speculation. Traders and investors frequently use historical performance analysis to identify short-term opportunities, such as buying and selling stocks or other assets within a relatively brief period. However, it is important to note that long-term investment strategies, which involve holding assets for an extended period, also play a significant role in investment decisions. Long-term investors typically focus on factors like fundamental analysis, economic trends, potential for sustained growth over several years or even decades. In summary, while the concept of looking back at past performance can be used for both short-term and long-term analysis, it is often associated with short-term perspectives in the context of Wall Street due to its relevance in short-term trading strategies.